Hello, Mike Swanson of Wall Street Window here, and I want to talk to you today about 5 doomed stocks, troubled stocks that are widely owned in the S&P 500. Now, over the past couple weeks in October, as we go into and begin this October earnings season, we have seen a tremendous bounce in the stock market, and there's nothing like a stock market rally and higher prices to make most people want to buy, especially people who do nothing but watch CNBC and Cramer and Fast Money and some of these stock picking shows. They see the market go up, then they feel compelled to buy, but that type of behavior leads to buying at tops and leads into big trouble if you get in the wrong stocks. So take a look at these couple stocks. The first one I want to talk to you about is Bank of America. And I got to explain to you why this stock is in trouble. There's 2 danger signs that you need to look for. First of all is the relative strength ratio, which is the line directly below the stock chart plot above. That's the top, the candlestick chart, and next is the relative strength chart. What that does is divide the price of the stock, in this case Bank of America, with the S&P 500. When this ratio goes down, that means the stock is underperforming the market. When it's going up, the opposite is taking place. Now, what happens typically is when a stock underperforms the market, it goes up at a less of a rate, a less of a percentage rate as the stock market does when the stock market goes up. But then when the stock market goes down, it drops more than the average stock in the market. So it's a money-losing stock if you continue to hold it. Now, the next thing, and this has been trending down since July, Bank of America. Notice Bank of America is below $16 and isn't above its September high, while at the moment that I do this video, the U.S. stock market averages are at that September high. So that's just telling you right there what the indicator is telling you, but that's bad. Now, the second thing that's a trouble sign is on-balance volume, which is the bottom indicator. It's trending down, going lower and lower. Now, what that indicator does is it tallies up the volume on up days. So it goes up when there's an up day and tallies up the volume on the day. But when there's a down day, it subtracts the down day volume. So this indicator goes down when there's more selling on down days and there's buying on up days. So it's a sign of distribution when the on-balance volume indicator is in decline. Combine that with a weak relative strength plot, and this is a dangerous stock to continue to hold. You see, when the stock market turns down again and has a correction or a big drop, this stock is going to lead to the downside. It'll go below the August lows and it will turn into a disaster. Now, eBay, shockingly enough, is in a very similar position. Notice eBay is languishing near the August lows, unable to rally back up to where it was in September, even though the NASDAQ has done that. Relative strength is in a breakdown. On-balance volume is slowly trending down. It's not in a total collapse, the on-balance volume, but it's weak. It's a sign of distribution. It's a sign of trouble. It's a sign of danger. eBay is a stock to stay away from. It's a stock to sell if you own and to put that money to work somewhere else. The next stock I've got to tell you about is JP Morgan. Yes, I know it's a giant. Yes, I know people think Morgan is so powerful it's able to manipulate things, but not its stock. Its stock is in trouble. Again, notice relative strength in decline. Notice on-balance volume trending down. Notice that JP Morgan has been unable to rally back up to the September highs. This is a stock to avoid at all costs. The next stock I want to tell you about is Verizon. Even weaker than the other 2 stocks. Verizon went through its August lows in September, has bounced back up, but not able to even go back above its 50-day moving average, not even able to attempt to approach its September high. Its relative strength has been in decline for well over a year. On-balance volume has been trending down since May, a sign of massive distribution. This stock is a disaster to continue to hold, and as the stock market ends up falling again. After this rally plays out, this stock is going to lead the way down. It's stay away. The next stock to tell you about is Corning, the glass maker. Again, Corning's relative strength has been trending sharply lower since February. The stock fell completely to pieces in July and then in August, and the bounce has been pitiful. It's way off the highs of March. Relative strength sharply trending down, on-balance volume falling at an even sharper rate than the previous 4 stocks that I've shown you. You must stay away from Corning shares at all costs. In fact, if I owned Corning right now and saw this chart, I would sell and run for the hills and prepare to use that money elsewhere, because there are some opportunities to go long in this market, but you can only do it in the few sectors that are currently breaking away from the increasing instability taking place with the stock market as a whole. So stay tuned and for my emails, and I'll share more thoughts of what's going on in the market with you, more specifics and things that we can actually make money from. But stay away from these 5 stocks, definitely.